Hello, and welcome to the Banker's Fresh Perspective series in association with Bank of America Merrill Lynch. I'm Joy Macknight, Deputy Editor at the Banker, and I'm joined by Greg Murray, Global Product Head of High Value Payments, Bank of America Merrill Lynch, to discuss how the major forces of change are driving an evolution in global banking. Greg, thanks so much for joining us today.
My pleasure.
What are the major forces that are driving a change in banking?
In the payment space, which is where I operate, there's three that I can think of. The first would be globalization. There's an increasing amount of commerce that's done across borders, whereas in the past it was largely focused on the domestic market. Second, you have demographics. You have a much younger generation, very tech savvy, mobile enabled, that is looking to do more of this commerce and do it with peers in other countries. And thankfully, that technology does enable that cross-border commerce. But on the other side of the coin, you also have regulation, which has become increasingly complex and harder for banks to navigate, especially when you look at the cross-border space.
Okay, and you touched on globalization. How does that impact cross-border transactions?
I think that the biggest trend, if you will, with respect to globalization is the fact that marketplaces and the commerce that you do across them has become borderless. Doesn't mean that the regulations that govern those payments are borderless. Every country tends to have different rules and regulations about what you can or cannot do and what you have to or do not have to do. But at least in terms of the underlying business, the transactions that flow, that's very much a very global phenomenon.
Okay. And it's very interesting because obviously globalization impacts a corporate's business and how they do business across the world. Mm-hmm. Do you see that their expectations, especially in cross-border payments, are changing, and how are they changing? Many
of these, what we call fintechs, have changed the game. They've raised expectations, typically for the consumer set. But everyone who's a consumer typically works somewhere else as a professional. And whether you're a corporate treasurer or someone managing accounts payable or accounts receivable, you're going to take those expectations into work with you, and you're going to wonder, well, why can't I get this from my main provider, which happens to be a bank? It's not as important to be fast, but it is exceptionally important to be transparent and to be very clear with respect to the information surrounding the payment. If a corporation receives a payment into their accounts receivable system, they want to know what it's for, and oftentimes that information doesn't carry with the payment. So I would say information, transparency, to some extent speed, and certainly lower cost.
Okay, but do you think that the banks can respond to these corporate demands? Do you think the correspondent banking model needs to change, and how could it change?
Yes, I do think it can change. I do think it needs to change, and I do think it can change. At Bank of America Merrill Lynch, we have, for the past 5 years or so, we've implemented a number of what I would call evolutionary approaches to how we improve the experience for our customers. One would be our accelerated payments to Asia, which enables payments to be delivered through fewer banks to get to the end beneficiary. So it cuts down on the time it takes to move a payment from one part of the world to certain parts of the world where the dollar is still a major settlement currency. We're also looking at connecting networks together so that a payment can be delivered through various networks without necessarily having to go through multiple banks. And most recently, and this isn't just Bank of America Merrill Lynch, this is us working with many of our competitors and our client banks, and ultimately under the auspices of SWIFT, to relook at what is it about the correspondent banking model, among the potentially several areas for improvement, what are the most acute issues today as we compare ourselves to what may be the new normal of greater transparency and speed. And we've come up with this initiative called the Global Payment Innovation Initiative. And in that initiative, all of us are working toward increasing the amount of transparency around where a payment is in any given status or any given state of the movement of money, providing a tracking number, just like you would if you were tracking a package, declaring fees. Those are not very transparent today. And then finally, service levels. Today, it's very difficult for a bank to guarantee a payment will be done by X amount of time because it depends on other banks to deliver the payment. It's not typically a one bank show. And with all of us, there's about 90 banks now, I think, in this initiative. As we work toward implementing the GPI and committing to those rules around transparency and traceability, fee declarations, then it will become a much better experience for our corporate clients.
Okay. And what other technologies are coming to play that will actually maybe be game changers within this space?
With this distributed ledger technology that some of the fintech and blockchain companies have proposed, there's a concept in there in which you could do a lot of that information, how do we say it, information verification, such as checking the balance on the account, making sure that the parties to the payment have accurate information, making sure there aren't any sanctions violations. A lot of that could be done simultaneously, all at once. And if it can be done that way, then ultimately, even if you have multiple legs to the payment, the settlement process itself becomes instantaneous, I guess is maybe a good word, or simultaneous, maybe that's a better way of putting it. And in that case, you create not only better speed, but you lower the cost associated with what we as banks have to do, all the obligations we have as it relates to payments. And that could also have benefits to our respective customers.
Okay. And my last question is, obviously the correspondent banking model is an old model, but as we've discussed, it's going through a lot of change. How do you see it maybe in 5, 10 years' time?
Well, I do see, the correspondent bank model has evolved over decades. So I don't see it changing overnight. I do see it changing though. Number one, I think the GPI initiative will make it much more transparent. If you look at phase 1, which is fees and tracking and tracing and service levels, that's only just the beginning. There are other concepts that we are all exploring that include new types of payments, such as pay me instead of push. In fact, I would argue too that whether it's correspondent banking or any other form of payment, most of the payments in the next 5 years will be increasingly driven by how the receiver wants to receive the money, as opposed to today where it's largely driven by how the payer wants to send the money. All right. So on top of the GPI and that sort of platform, which again is evolutionary, it's not markedly changing how the settlement works, it's just putting more transparency and greater certainty around it. I then also see a second trend, which would be, if you look at domestic real-time payment systems, you look at Australia's NPP system or the UK faster payment scheme. Those are very domestically focused, but in the case of UK faster payments, which has been around for many years now, it's received quite a strong reception. It's well adopted, and I see the future as potentially linking many of these systems around the world together. Japan has one, Singapore, India. What's to say that those networks couldn't be linked together somehow through maybe SWIFT or some other network and turned into a cross-border alternative to correspondent banking, perhaps a lower cost alternative for low-value payments.
Okay, great.
Right?
Thank you so much, Greg.